I remember back in the early 1990s, the internet was this odd little thing that a few geeks and academics were tinkering with, and most people didn't take seriously. People were skeptical. They thought it was a fad, a toy, not a place to build serious businesses. But I had learned over decades that the biggest fortunes often came from being stubbornly rational in a world full of conventional thinking. And that's what I saw when I looked at Jeff Bezos. That kid from Princeton had an obsession, a clarity of vision, and a willingness to endure pain that most people are too lazy, too impatient, or too scared to endure. I could see the DNA of compounding long before anyone else noticed it. Amazon was going to be one of those rare opportunities where patience, rationality, and a little bit of audacity would generate unimaginable returns. I don't want to romanticize it. Amazon wasn't a sure thing. Far from it. In 1994, Bezos left a cushy hedge fund job, a place where he could have earned a good living, probably had a lifetime of comfort, to start selling books online. Books. People thought he was nuts. They told him, "Nobody buys books online. You'll fail." But Bezos wasn't betting on what people thought. He was betting on what was inevitable. The internet was going to change commerce. Information was going to become liquid. Logistics were going to become a competitive advantage. That's what he saw, and he didn't care if people laughed. He started in a garage in Bellevue, Washington, with a handful of people and a determination to get something right over a long time horizon. This is where a lesson hits hard. Real wealth is built by doing things differently and being patient. Bezos didn't need to prove himself in the first month. He didn't need to satisfy analysts or chase quarterly earnings. He was thinking decades ahead. Most people can't think that long. They're too scared of short-term pain, too busy chasing recognition, too busy thinking they're clever. Bezos wasn't like them. The first challenge was obvious: logistics. Selling books online in the early 90s was not the sexy part of the internet. You needed warehousing, shipping, inventory control, software that actually worked. That's hard. Most people underestimate how hard the operational side of a business is. Jeff understood it wasn't glamorous, but he knew it was essential. He got the warehouses, the shipping systems, the software, the whole supply chain right. And he kept reinvesting everything into those operations. There was no dividend. There was no personal luxuries. It was grind, obsession, and patience. That's a pattern I've seen over decades in every successful company. They obsess over the fundamentals and ignore the noise. Investors in 1997, when Amazon went public, were unsure. The stock was priced at $18 per share, and people were already complaining it was too expensive. Some analysts said it had no chance of profitability. But here's the thing about genius entrepreneurs: they don't operate according to other people's math. They operate according to a long-term model. Bezos wasn't trying to make a few bucks next quarter. He was building a platform, an infrastructure, a flywheel that would eventually dominate commerce. He was buying time. He was buying the chance to compound an advantage over decades. Now, let's talk about compounding, because it's the core principle most people miss. Compounding is not just interest. It's knowledge, reputation, operational scale, network effects. Amazon's flywheel wasn't magic. It was rational. Lower prices attracted more customers. More customers increased volume, which justified better logistics and economies of scale. Better logistics lowered costs, which allowed lower prices. Each cycle reinforced itself, and that cycle compounded over years. If you start early and let compounding do its work, the numbers eventually become absurd. That's exactly what happened. The early investors who understood patience were rewarded, and those who panicked and sold in the dot-com bust which almost everyone did, missed decades of exponential growth. Of course, there were near-death experiences. The dot-com bust could have killed Amazon. In 2000, the company was burning cash like a madman, and the stock collapsed. Most companies in that situation would have been liquidated, but Bezos made rational decisions. He cut unnecessary expenses, doubled down on the core business, and refused to chase hype. That's another lesson that applies broadly. Avoid stupidity, don't get carried away, and survive long enough to see compounding work. You don't need to be brilliant every day. You just need to avoid catastrophic mistakes. Most entrepreneurs fail not because they're not clever, but because they run out of cash or make irrational decisions under pressure. Bezos didn't make those mistakes. The leadership culture he built was also crucial. He didn't create a bunch of yes men. He built a company where rational dissent was encouraged, where operational excellence was worshipped, and where incentives aligned with long-term thinking. People were frustrated sometimes. The culture was harsh, but it produced results. There's a lesson there for investors and entrepreneurs. Culture compounds just like capital. A bad culture destroys wealth slowly, but inevitably. A good one multiplies it exponentially. Now let's talk about diversification, which Bezos executed brilliantly. Many founders get greedy and chase fads. Amazon started with books, then CDs, then DVDs, then electronics, then cloud computing. Each step seemed risky, but he treated every new initiative like an experiment backed by rational analysis and long-term potential. AWS, for example, wasn't just a new business. It was infrastructure that became an unstoppable cash-generating engine decades later. Again, patience is the secret. Most companies chase immediate returns. Bezos waited. He let AWS mature, and now it funds almost everything Amazon does. Customer obsession is another reason Amazon survived while others failed. Most CEOs obsess over competitors or Wall Street. Bezos obsessed over the customer. Because incentives matter. If you serve the customer exceptionally well, they reward you with loyalty, volume, and word of mouth that compounds over decades. That's rational, that's simple, and yet most executives miss it because it doesn't provide the immediate thrill of a quarterly earnings report. I've seen it over and over. Companies that chase short-term recognition instead of compounding advantages fail. Amazon focused on customer satisfaction relentlessly, and it became an unassailable moat. One thing most people underestimate is the audacity to lose money rationally. Amazon lost money for years. That's terrifying if you're not rational. Most people panic. Most investors panic. But Bezos understood leverage in a different sense, operational leverage. He invested in the flywheel, knowing losses in the short term would produce enormous gains in the long term. That's counterintuitive for most people. Human psychology hates delayed gratification, but if you can stomach it and understand the rational math behind it, you can build something extraordinary. And that brings me to risk. Bezos took enormous strategic risks, but calculated ones. He didn't gamble. He evaluated probabilities, margins, and potential compounding effects. Risk isn't about being cautious. Risk is about understanding what matters and what doesn't. Most investors and CEOs confuse volatility with risk. They sell when things go down, panic when things are uncertain. Bezos ignored noise. He survived crises, learned from them, and compounded his advantage. By 2005, Amazon had become a juggernaut. E-commerce was mainstream. The infrastructure was dominant. The culture was unstoppable. Bezos didn't become complacent. He doubled down. Kindle. Marketplace. Prime. Each step made the company stickier, more indispensable, more capable of generating irrationally high returns over the long term. This is the kind of thinking that separates billionaires from the rest of humanity. Relentless focus on what matters, patience, and avoidance of stupidity. I want to emphasize one last lesson from Part 1T, the human element. Bezos's obsession, discipline, and rationality weren't innate genius in isolation. They were cultivated. He read, he thought deeply about incentives, he surrounded himself with people who were better than him in certain areas, and he accepted being uncomfortable. Most founders quit when it's hard. Bezos leaned into the hard. That's why Amazon exists today. Now we're just scratching the surface. There's part 2, where we go into Amazon's domination of multiple industries, the Bezos succession plan, the lessons from the public market, and the psychology behind how such a massive company continues to survive while almost every other e-commerce competitor has fallen. By the late 2000s, Amazon wasn't just a bookseller anymore. It had become an ecosystem, a machine for compounding advantages, the sort of business where rational patience produced results that bordered on absurdity. Most people don't understand that the compounding Bezos engineered wasn't about flashy products or marketing gimmicks. It was operational, it was psychological, it was cultural. He understood that once you build a flywheel, the forces you unleash will accelerate themselves over decades. And if you survive the early years, the exponential growth is inevitable. That's the quiet miracle that almost no one sees when they look at Amazon. Think about Prime. On the surface, it seems like a simple membership program, pay a fee, get faster shipping. But Bezos understood the psychology and incentives perfectly. Customers who subscribe stick around. They buy more often, and the operational improvements from handling those customers efficiently, warehouses, software, logistics, improve the experience for everyone. Each element compounds the other. That's why Prime became a moat so durable, it's almost laughably effective. Most companies chase short-term profits and ignore long-term sticky advantages. Bezos did the opposite, and that's why Amazon survived competitors who spent years trying to catch up. Now, let's talk about AWS. Amazon Web Services looks like a business you couldn't possibly connect to an online bookseller in a garage. But it's precisely the sort of rational, patient, and audacious bet that Bezos excels at. Infrastructure is boring. Most people hate it. But boring infrastructure produces predictable cash flows, economies of scale, and leverage over competitors. AWS didn't just become a revenue machine, it became a strategic. It allowed Amazon to subsidize other ventures and continue reinvesting aggressively while other companies struggled to survive. That's the genius and the risk. Only someone with an iron stomach, someone willing to forego short-term validation, could pull that off. And make no mistake, Bezos has made mistakes. He's lost money on countless experiments, from Fire phones to Amazon restaurants. But here's the subtlety: he never confused a failed experiment with a catastrophe. He failed small, learned fast, and never allowed those losses to destroy the core compounding engine. Most CEOs panic when a mistake occurs. They fire people, spin off divisions, or abandon long-term strategy. Bezos treated mistakes rationally, extracting lessons and moving on. That's a lesson most people never grasp. Survival plus rational adjustment beats brilliance every time. Now, the public market is a different beast. Investors are emotional, fickle, and addicted to narrative. Early Amazon investors were terrified during the dot-com crash. Later, they complained that the company wasn't profitable enough. They panicked during economic downturns, but Bezos ignored them. He treated Wall Street as a bystander, not as a judge. He focused on the rational mathematics of growth, scale, and compounding advantages. That's something every serious investor should understand. The market is not a rational evaluator of value. It's a voting machine in the short term, but a weighing machine in the long term. And if you can endure the noise and think rationally, you can compound advantages while others panic. Competition. Amazon has faced plenty. Walmart, Target, Best Buy, eBay, Google, Alibaba, all formidable, well capitalized. And yet Amazon survived. Why? Operational excellence, customer obsession, reinvestment, and scale. When you build a machine like Amazon, it's not about outsmarting competitors in any single moment. It's about compounding multiple advantages over decades. That's why people often overestimate the threat of competitors in the near term and underestimate the long-term durability of rationally built systems. Now, the Bezos succession plan. People obsess over leadership transitions, but rationally speaking, the succession is just another compounding decision. Bezos didn't abdicate because he was tired. He didn't leave because he thought the company would fail without him. He structured the transition to maintain the core principles: long-term thinking, operational excellence, customer obsession, and rational reinvestment. The lessons here are broader systems and culture can outlast individuals if they are deliberately designed to do so. That's the difference between transient companies and enduring ones. Let's take a step back and think about what made Amazon survive while countless .coms and other startups perished. It wasn't luck alone. It wasn't intelligence alone. It wasn't even vision alone. It was a combination: rationality, patience, operational obsession, culture, audacity, and a refusal to panic. Bezos invested time and effort in areas others ignored, allowed compounding advantages to accumulate, and avoided catastrophic mistakes. Most companies fail because they chase the wrong things: hype, short-term profits, vanity metrics. Amazon succeeded because it did the boring, rational work that most people hate, but that compounds extraordinarily over decades. And the psychology behind this is fascinating. Human beings hate uncertainty. They hate delayed gratification, and they're addicted to stories that make them feel smart today. Bezos ignored all of that. He embraced delayed gratification. He thought in decades, not quarters. He surrounded himself with rational people who could challenge assumptions. He didn't care about recognition. He cared about building a machine that could dominate the market for decades. That's what separates billionaires from the rest of humanity: the ability to think rationally, avoid stupidity, and endure discomfort over long horizons. Now, there are controversies, regulatory challenges, and criticism. Amazon is massive. It's complex. It employs millions. It touches almost every aspect of commerce. There are labor disputes, antitrust concerns, environmental criticisms. And yes, some of those are rational. But here's a hard truth: almost every company of this scale will face challenges that look existential in the media. The difference between survival and failure is not avoiding challenges. It's handling them rationally, learning, adjusting, and continuing to compound advantages. Bezos and Amazon have done precisely that. And let's not forget about Bezos himself. Most people see him as a tech billionaire, a mogul, or a visionary. But the deeper lesson is his mindset. He's rational. He reads constantly. He surrounds himself with smarter people. He embraces long-term thinking. He avoids stupid mistakes. He leverages time and compounding. That's a playbook for anyone, investor or entrepreneur, who wants to build something that lasts. Intelligence alone is not enough. Ego alone is deadly. Patience, rationality, and operational excellence, those are the real levers of success. By 2020, Amazon was a behemoth: e-commerce, cloud computing, logistics, AI research, media. And yet, even at that scale, the principles hadn't changed. Lower prices, customer obsession, reinvestment, operational excellence, long-term thinking. The company's culture was the engine. the culture compounding. And that's why it will likely survive and thrive long after Bezos steps down. Human capital and culture are compounding assets, just like capital, undervalued, visible to most, but decisive over decades. And here's the final lesson: Amazon teaches patience more than anything else. Investors who bought in the 1990s and held through crashes, recessions, and skepticism reaped absurd rewards. People who tried to time the market, chase short-term returns, or panic sold far below their potential. The math of compounding is cruel to those who act emotionally and merciless to those who act irrationally. The key is to survive, avoid catastrophic mistakes, and let the rational machine do its work. That's true for companies, that's true for investors, that's true for life. So, when you study Amazon, don't just study the flashy products or the headlines. Study the rational patience, the operational obsession, the culture, the customer focus, and the long-term mindset. Those are the levers that created extraordinary wealth. Not gimmicks, not luck alone, not clever marketing. Bezos built a system where advantages compounded for decades, and by doing so, he created one of the most remarkable stories in business history. And if you internalize this lesson, you'll understand more than just Amazon. You'll understand why certain companies survive and thrive, why certain investors get rich, and why most people, smart, hardworking people, never achieve extraordinary outcomes. It's about compounding rational advantages, avoiding stupid mistakes, enduring discomfort, and thinking in decades rather than quarters. That's the essence of the Amazon story, and it's a lesson that applies far beyond books, e-commerce, or cloud computing.